Hey everyone, welcome to Red's Roundup. In this video, we're going to be looking at a company called FIGS, and they are a niche luxury brand. And so their main product is scrubs. So scrubs are what nurses, doctors, medical professionals in general wear to protect themselves and as a work uniform. So if you go to a dentist office, you'll see somebody wearing scrubs, nurse, scrubs. They pretty much all wear scrubs. And for the most part, that industry has been dominated by cheaply made, uncomfortable scrubs. This is where FIGS comes in. FIGS is trying to be the Lululemon, so this is the Lululemon logo, the Lululemon of scrubs. And I would say they're pretty close to becoming that, actually. So as you can see, that they're soft, whereas traditional scrubs, you might notice, are sort of hard, scratchy, not very comfortable. They're a little bit more stretchy, so they have a little bit of a give to them if you're ever stretching or reaching for something, and they're not as wrinkly. And what you'll notice too is that they look a lot more fashionable, and that's a really important point for the main demographic of these scrubs, is that they look good and that they feel good, and that they remind you of Lululemon and other high-end sportswear type of products. So here's a various lineup of some of their products. Basically, the main thing to keep in mind is scrubs. They have some ancillary products that are coming up, but they represent a pretty small portion of their sales. And as you might guess, their target market, their target demographic is millennial females in the medical profession. So that'll include like I said, nurses to doctors and dentists. So those are pretty high-paying professions. And if you think about those demographics, they've got a lot of money to spend. Say you're a similar earning profession, say investment management, just for instance. You're going to be making a lot of money. You're going to want to look good at your job. You want to be able to show that, okay, I know what I'm doing. I look good on the job. It's the same thing for these nurses, doctors, dentists. They want to look good on the job. They want to feel comfortable, and they want to have the clothes that they want to wear. They don't want scratchy clothes. And men, some too, but the main demographic is women. And when you're researching this company, I would focus on how does the female medical professional consumer think of this product, and how do they think of competitors' products. And so here are some of the core statistics to keep in mind with FIGS. These are just a few. So I took this from their prospectus, their S1. We have built the largest direct-to-consumer platform in healthcare apparel, leading the industry in the shift to digital. So their primary way of selling to consumers is through their website and mobile app. They have 1.5 million active customers, which is a lot, but if you compare that to the total market of medical professionals, it's pretty low. And then we see that with their net revenue of $263 million. We're going to get more into these numbers when I show you my valuation spreadsheet and just how I would think about this company if I was investing in it. And so they've got really high growth right now. Gross margins are really high for a clothing company. That's extremely high. And adjusted EBITDA margins are quite high for a clothing company. We're going to come back to those margins in the valuation. And net promoter score. This one at the bottom might not seem very big, but it's a big deal. Net promoter score is how likely are customers to be satisfied with your product? How likely are they to recommend that product to a friend or colleague? And above 0 is satisfactory, above 30 is really good, and 81 is almost unheard of. So companies like Nike are sitting around in the 30s, and I think Lululemon is in the 30s too, and FIGS is in the 80s. And I've actually talked to some people who wear FIGS. They are in the target demographic, women, 25 to 30, millennials, working in healthcare, and they love FIGS. They say FIGS is the thing to have. If you're not wearing FIGS, like you don't feel as comfortable. It's really a brand. People like that FIGS brand. It makes them feel like they're wearing Lululemon or something like that while they're at work. So that's a really important thing to keep track of. And so some more important info. FIGS stock has a dual class structure. They do have a dual class structure. A and B shares So the founders and then another major shareholder who control the higher voting right shares, they control almost 80% of the voting rights. So you really are, if you own the non-voting shares or the non-higher power voting shares, you're really a minority shareholder here. You're along for the ride. You have to rely on the fact that this is a founding management team that wants to make money for all shareholders and not just take all the profits for themselves through executive pay. So FIGS only has one non-employee director. So look here, high management ownership, high management voting power, few people outside the management team. So it's really like the management team is going to do whatever they want and you aren't going to stop them. And if they're wrong, you're going to go down with them. But if they're right, it's going to go really well. And 98% direct to consumer. And then here's the big one. 82% of FIGS net revenue is generated by core scrub products. So that includes all the things we looked at earlier, a lot of the basic stuff. They're trying to, the other 18% or so is in other products like accessories, or they're trying to diversify more into consumer products, but I would be wary of that because their brand is the scrubs. Their brand isn't clothing, their brand is scrubs, in my opinion. So I would keep track of that. So next we're going to look at some of their other things, website, how to learn more about their products, etc. So a couple places that I would look if you want to learn more about FIGS, their market, and their products is just go to their website, sort of click around. You'll learn a lot, and just by getting a feel for the website, you'll understand what it is. Like if you've been on like a Lululemon website doing research, or some of these other higher end female products, you'll understand like this is pretty much what they're going for. Their website matches the target market and the demographics. They're not here with a bunch of crazy stuff, pretty minimalist and focused on the products. And you get the feel on their website that it's a clean site, not dirty, which is what you want with scrubs. You want them to keep you clean, and you want to feel clean when you're sometimes in some pretty dirty environments. So I would take a look at their website, just click through some of their products, look at their best sellers, look at some of their new products to see what is going to be at the forefront in the coming years. And then also I would look at YouTube. So I just pull up YouTube here, best scrubs. I watch this one just to see what does someone in that environment, what do they like? I sort of scrubbed or filtered through the video, found what I liked. I would just watch some of these videos, even though this is not my thing, I'll tell you, and it's probably not your thing either, watching these types of YouTubers, but I would just watch a video if you want to get a better feel for the products, the target demographic, etc. Those things are really important. That's why I keep stressing them. And we're going to see that in the valuation model here. So all values in the thousands, let's remember that. So sales right now, 263 million. So remember all values in the thousands for 2020. These are the most recent numbers we have pretty much. Net margin of 18.9%. So right now Nike is like around 10, and Lululemon, what's their margin at? Let's see here. Gross margin, profit margin of 13%. So FIGS margin is actually really high for a clothing brand, which is probably because of their concentration on a product and their lack of stores, since they're mostly all online. So we have a high margin, net income of 49 million, and that translates to a multiple if we're at a $6.3 billion valuation of 127 times earnings. So that is a lot, and you are going to need a lot of growth over the next coming years. I'm picking 10 years to make that valuation profitable for you in the end. So we've got a bear case, base case, a bull case, and sort of an ultra bull case, which is the case that if you're long this stock, you really want to be true. So bear case, let's take a look at this scenario. So in 2030, we're doing all of our final valuations in 2030 because let's just say they have about 10 years of high growth in them, and then after that it's going to slow down. We can sort of see that in Lululemon. This is Lululemon, their financials. This top line is their revenue, top line. So when they went public, they had really, really high growth. This is very similar to FIGS, because FIGS is saying they're at over 100% revenue growth, which is not going to be sustainable. And you can see after that, they went down to low double digits after that, so 13%, which is what I think we can expect. We could expect really high growth for the next couple years, but then it's really going to fade off, and that's going to be incorporated into my model. We're only going to say they're going to grow at a high cumulative annualized growth rate, CAGR, for the next 10 years. So 2030, in this bull or bear case, we have them growing sales at 10% and their margins dropping down to 14% to more fall in line with their product, their competitors, say, or similar companies like Lululemon. So then they would be at $600 million of sales, and that would translate into, let's just change that here, $95 million of net income, and then applying an 18 times multiple to that gets us a value of $1.7 billion, which translates into a negative 12% CAGR, so that's really bad. If the base case is true, that this company is pretty much uninvestable, if you think it's true, base case here, this is sort of, man, they're pretty much going to continue as planned. Maybe a little worse than what the highest estimates are, but you could pretty reasonably count on this. And this is using this number over here, sorry. This was from Lululemon. Their sales CAGR for their first 10 years was 31%. So I said, okay, maybe they're not Lululemon. Lululemon's a one-of-a-kind operation. Let's say they're a little bit less. So they're 25% sales growth rate here. That gets us to, and then we use a 18% margin, 20 times earnings, gets us to a 3% return, which is pretty bad. If you're going to hold a company for 10 years and get a 3% return per year, that's not very good. You're going to need better than that. So that's with this pretty high valuation here. What's going on? So bull case, 31%. So let's say they're Lululemon. They're going to grow as fast as Lululemon for the next 10 years. What's going to happen? If their margins stay the same, 25 times earnings, you're going to get 11.5% return over the next 10 years. Okay, that's pretty good. I think if that's me, if I could get 11% return over the next 10 years, I would take it. I would lock it in. Ultra bull case, if they're one of the greatest companies ever and they're just a massive home run, they come out with all sorts of products and they dominate the medical field. They get over half of the total addressable market for scrubs, which would be a lot, which is $12 billion. I did some research on that. Their margins are even higher at 20%, and you apply a 30 times earnings. That gets you to a 21% annualized growth rate. And then, okay, you might ask, so where do you think they're going to grow over the next 10 years? How do you think they're going to grow? What number is that going to be? If you really pressed me, I would say it's pretty unlikely that they grow at 31% like Lululemon did. I would say you're somewhere in between here, in between 25 and 31%. But really, I think there is potential for this to be one of the great brands. But it's going to be hard. There are many competitors coming up, as you'll see if you watch some of those YouTube videos. But FIGS has, in those videos and from the people I talk to, FIGS is by far the best quality. It's by far the most recognizable brand, and it's by far the favorite of everybody. So if they can hold that market position, I think they could grow at these rates, not to mention the growth of the overall market. So let's say this TAM grows to $20 billion and they get half of that, it's $10 billion. They're in a market where it's possible for them to make a lot of money. We'll just have to see if their high margins and high valuation multiple will justify themselves over time. And so that's really what I would say about FIGS is I'm not clicking buy yet, but it's definitely on my watch list. If it gets down to the point where let's just change the value here. Let's say it's a let's say it's a $4.3 billion company. I would pick it up at $4.3 billion because let's say they just grow 25% and then they're selling at 20 times earnings after that. 7.5% over 10 years is not that bad, especially when you have all that optionality towards the upside for them to develop new products, etc. And let's say it gets cut in half pretty much. The stock gets cut in half to $3.3 billion. You're sitting here, if they grow at 25%, you're sitting at a 10% return. And I would feel pretty good about that. So this is definitely a stock that's on my watch list that if it drops, if it starts dropping like it has, if we look at their chart here, it's dropped a little bit. If it starts to drop even more, I'm going to feel more comfortable picking up shares. Funnily enough, their IPO price was $19, I think, approximately, for you to subscribe to that, but only the super rich guys get that pretty much. Instantly went up to 30, and then to 40, and then to 50, and now it's back down below 40. So this is what happens with IPOs. They get pumped up, and then they go back down. So I would just pretty much wait and see. This price to earnings ratio is completely wrong. Don't pay any attention to it. So I would just be watching the momentum, wait for it to go down more, and when it does, maybe snap up some shares. Because if you do snap up some shares and it works out, you're gonna be sitting pretty. And this would be the type of stock that I would buy and hold for pretty much ever. So tell me what questions you have. Tell me if you want to see this model. I'll post it in the description for you to look at. Otherwise, have a good day. Leave a comment, like or dislike, and we'll see you later.